Your money this morning on For the Record. Good morning, I'm Neil Heinen. While not every economist would agree, and of course there is nothing every economist would agree on, but for the sake of this show, let's say the recovery seems to be taking hold and the economy is getting better. That has implications in many areas of personal finance, not the least of which is home ownership. So we brought in some experts and thought we'd start there this morning as I welcome to For the Record Summit Credit Union Vice President for Mortgage Lending, Christine Haraldson, and Summit Mortgage Loan Officer, Brett Wolfram. And thank you both very much for joining me this morning.
Thanks for inviting us.
Can we agree anyway that the recovery seems to be taking better? Is that sort of the approach that you're taking?
We've sure noticed a difference over the last few months of more and more home buyers coming in looking for information, and the statistics on the realtors' websites will tell you that.
Where should we start? Should we start with home buying, or should we start with refinancing? What questions are you getting asked the most about these days?
Boy, a little bit of both, because with the low interest rates, we're getting a lot of refinance questions. But starting with home buying, probably is the best place.
Yeah, and we've had a number of borrowers calling lately, asking about down payment requirements. There's still some mistruths out there that you need to have 20% down for the home loan purchases.
And that's been going on forever, Brett? Is that right?
Yeah, correct. And there are still minimal money down programs. There's a couple options with no money down. There's some 3% down programs, some 5% conventional programs out there. The key is having pretty good credit and being able to afford the payments. And there's options out there for people. Is
this a good time to be buying a home?
I think it's a great time. I've been doing this for 10 years, and boy, there's deals out there. It's probably the best time to purchase in the last 10 years I've been involved. There's a nice market. It's still a buyer's market right now, and the buyers are out there. We're getting a number of pre-approvals in, and they're coming with better credit and very apt to get approved for a loan.
So this is a combination of both availability of housing stock and sort of the banking conditions.
Correct. And we are seeing a lot of 3% down. So people don't have to have that 20% down like they think they have to have. The biggest change that we've seen this time, probably over 5 years ago, is credit quality. Is people needing to make sure that they don't have too much debt, and that their credit, they're paying their bills on time. And that's really the keys to home ownership.
How long a period of time does that take? I'm trying to think, if somebody watching this show feels like maybe their credit rating isn't what it needs to be, they start on it now. How long is the period of time before they can really realistically get into a home?
If they've had a foreclosure or bankruptcy, it's a little longer. You're looking at a minimum of probably 4 years since that time. Otherwise, credit can come back fairly quickly. It's working with a financial advisor to help you figure out what's the best way to do it. A lot of people think that paying off a credit card and then closing it is the best option, and that's not the case. You want to leave those open because it's all about availability. If you have a $10,000 credit card and you have $9,000 of it available, that's a great thing. It's better than having either $10,000 owed and $10,000 balance, the availability, versus having no credit at all.
Help me understand the 3%. I mean, it sounds like a low number. It sounds like an affordable number. What's the variance? How many homes how many loans are available at 3% down payment, as opposed to some of the higher numbers?
We currently have at least a few programs at 3% down. We have a fixed rate program, conventional, at 3% down. Another loan called My Community Mortgage, I believe, with 3% down. There's WIDA, which is a government program, with 3% down, and FHA with 3.5% down. And on some of those programs, there are income limitations, but on some there are not. So again, if the quality of credit is decent, we're looking a little closer at the debt to income ratio. So we're adding up all the monthly debt divided by the income to make sure people can afford the house. But boy, I would say at least a third of the people coming in are looking at some of those programs, probably more lately. We always encourage people to come in for a pre-approval. If credit isn't quite where it's at, we set them up for a meeting with one of our financial service specialists, and they'll help guide people in how to improve their credit. And it can be as little as 6 to 12 months in some scenarios. But as Christine mentioned, if there's some more serious issues out in the past, it can be longer too.
Is there a generally agreed upon percentage of one's income that should be spent on housing? I mean,
absolutely. 45% is the key to this economy. But what that is people really have to think if that's too much, because it's 45% of your gross monthly income. And if you take that and back it off and work with it as if you're writing checks each month and look at what you really bring home, you know, do you not want to put any money in your 401k? Do you not want to have anything available for extra expenses?
Right,
so
right.
45% is pretty liberal.
45% of gross is what you,
gross.
yeah,
So that's very liberal.
Yeah,
and that's currently what it is. But the nice thing that they've changed is that it used to be a certain percentage could go to your home and a certain percentage to all your debt. Now, what's wonderful is that for those people who don't buy a fancy car and their car payment may be $200 and they don't buy a $600 a month car payment, they can have a little more house. So it's all about that total debt ratio versus how much one person should spend on housing versus another.
Someone comes into your office. You walk through all of this stuff with a...
Yeah, and with all our clients, my message is that the most important thing is to get that monthly payment where it's comfortable for you. Because I've always felt if you're going to 45%, if that's the most you can get approved for, you have to feel real confident in your jobs, real confident you're going to make more income going forward, because you don't want to drain out all your money for your house. That 45% isn't really taken into account if your employer is taking any money out of insurance or toward the 401k.
Sure.
But when somebody comes in, a lot of times I'll run through all the numbers on paper with them and figure out about where their ratios are, where some different payments are on mortgages that they're looking for. And then if they want, we'll put a full application on and get them pre-approved or see where things are at.
Yep. So. We're going to continue our conversation of home ownership in 2012 when we come back right after this. I am back with Christine Haraldson, who is the Vice President for Mortgage Lending at Summit Credit Union, and Brett Wolfram, who is Mortgage Loan Officer with Summit Credit Union. And we're talking about home buying as the recovery continues to grow and the economy gets better. When someone comes into you, how much time do you spend with them about what they should look for in buying a home? Is that something you concern yourselves with in terms of talking to a client? The location of the home, the size of the home, that kind of stuff?
We actually encourage them to work with their real estate agent on that. We tend to try to stay on the money side. However, we do remind them about the things. For example, do they really need a 2-car garage or is it a 1-car garage? And so what they need to do is they need to put their wish list together and then start backing it off of what they really, really have to have, because it is so easy. Just like when you go out and you see that shiny car and you want the one with the navigation system, but you really can't afford that one. So you have to be realistic, and to get a couple together is not always easy to do that. But as far as the financing piece then, about an hour and a half when you've got a first-time home buyer that really doesn't know anything about the process. So that works out really well, because you go through, here's how things work, here's what you should be looking for. Do you have a real estate agent? Do you have someone that you truly can trust? And you should be interviewing them just like you interview anybody else that helps you make a big financial decision.
Yep. Are people still paying a lot for location? I mean, does that drive the cost of housing?
Oh yeah, Madison is very much pocketed in Dane County. You know, you'll see various neighborhoods, you know, is very much restricted and pocketed to that particular group. You don't see, you know, a $100,000 house next to a $300,000 house, and you never will.
Yeah. What does pre-approval mean? What's involved in that?
Well, pre-approval, we're basically verifying the income, the assets, and the credit. And when somebody's coming in, if they're taking an application for pre-approval, we're collecting all documentation for the last couple years and seeing where their current income is, and we're submitting that application after pulling credit, reviewing the credit scores with them. We're submitting it to an online underwriting system, kind of governed by Fannie Mae, and we're just verifying that things look good for them to get approved for a fixed rate mortgage. And after they're pre-approved, if they find a home that's in good condition within that price range, everything should go smooth as silk. And at the same time, part of the pre-approval process is to back it up and again go back and ask where they want to see that payment at. Talk to them a little bit about the properties. I do several loans in Jefferson County as well as Dane, so I would reflect what Christine's did, where if you're getting a little closer to Madison, there is some value in living nearby. But for the most part of pre-approval, we're making sure they're ready to go out and buy a house. And there's times where if somebody wants it, we can issue a pre-approval letter on the spot. And of course the realtors love hearing that because that means we pulled up their credit and we verified that they're ready to buy a home.
I would assume that most people who come in to see you don't know what their credit score is. Is that right?
More so now than ever before.
Are they getting more savvy
because of all of the online things? So they tend to know and they ask. It's really interesting to watch the couples compete over credit score. Mine's better than yours, yours is better than mine. So it's fun that they're actually looking at it and caring about it because they didn't used to, you're right. But now that drives everything from what they can afford to what interest rates on some programs, how many costs they're going to have to pay on other programs. So that score is more important now than ever before. And they're starting to go online and get some of those scores. They just have to be careful of where they're looking for the information.
And is there a sort of a generally, does the industry have sort of a consensus on what the score needs to be? Does that vary at all from lending institution to lending institution?
Oh, and very much from program to program. There's programs that your credit score could be 620, and there's other programs that when you get into the 3% down programs of certain, for example, WIDA, you know, you need to be a much better credit score. You need to be in those 680s, 700s. And really, when you get into some of the lower credit scores, it's important, are you really ready to buy? So is it that your credit score is not as good because there's been issues in the past and you've corrected them, or are you truly not ready to buy yet? And this is not a good time and you need to just kind of think through it. Renters, a great example is if you have rent of say $1,000 a month, but you think you can afford $1,500 in a home payment, then that $500 a month should be going in a savings account. And if you can't save $500 a month, then can you really afford a $1,500 house payment?
Yep, and often the lower credit scores on some of the fixed rate mortgages, what they also mean is your fees will be higher. So, so we're truly offering a lot of advice on how to improve the credit in being careful there. As Christine said, if your score is around 620, there may be some things to fix, but within a year, you can get up to where you're getting a wonderful mortgage with minimal fees. Generally, 740 and above is classified today as A++ credit. And what's changed, I would say, in the last 7 years in the industry is 7 years ago, a lot of these programs you got approved or you didn't, but we didn't have to worry about the closing fees going higher. Versus now, a lot of that is credit-based, so we have to watch that pretty carefully.
And then, we've been throwing all numbers here, but escrow and tax payments and that kind of stuff, that's on top of the numbers that we're talking about, right? For the typical payment.
When we're figuring all the ratios, we're having to include the monthly taxes, the monthly homeowner's insurance, the private mortgage insurance, if there is any on that particular loan. So when we're figuring out the debt to income ratios, we're figuring out a full payment, plus everything else that would report on the credit report, such as car loans, credit cards, student loans. If you've co-signed for student loans, we have to work those in as part of the ratio. And if those loans are deferred, we have to estimate a monthly payment to get worked into those ratios as well.
All right, we're going to talk more about home ownership and talk a little bit about refinancing when we come back right after this. Well, you're doing great. There's a couple of seminars coming up, home buying seminars that our friends at the Summit Credit Union are putting on First one Thursday, April the 19th at the Bonfire Grill here in Madison. It's from 6 to 8 p.m. And the second is in Milwaukee at the Summit Credit Union on Miller Parkway, so right near the ballpark. It's Wednesday, April 25th, also from 6 to 8 p.m. And Christine Haraldson and Brett Wolfram are with me this morning talking about home buying. What do people ask at these things? I mean, is it just, I suppose, everything you can think of, huh?
We try to bring in a variety of speakers for them,
okay,
and then leave the rest open to, for questions and answers. And what they do is we'll go through the whole process. What happens when you come to our office? What does the mortgage loan officer look for? How do you find a real estate agent? We'll have real estate agents come and speak. What about home inspections? Those are very, very important. People didn't used to do that. And you'd buy a home and find out that you have a lot of money that's going to go out the window on something that you just didn't know existed.
Yeah, and there are also a lot of them are focused in on the down payment as well. What programs are out there for the different sorts of down payment, and we do kind of map out the different programs we have and the different down payment options. So I think as you're looking into the people who are attending, they're trying to isolate a program or two that they think will work for them. And a lot of times they're asking questions about that, as well as some of the credit score requirements that we've spoken about.
Typically, how many people will show up for a seminar?
The last one, I believe we had 32 sign up, but there was about 45 people in there.
Okay.
So there were a
so you get
number
a chance,
of walk-ins.
you can ask questions and expect to get good information at something like that.
Yeah, it's very informal. We encourage them to ask questions right as we're as we're speaking. So yeah, they're asking a lot of wonderful questions about the credit, and they want to know about the ratios, because some of them brought their calculators and they were calculating out about what they felt they could afford as well. So.
Okay, so shifting gears here a little bit, when should people refinance?
Now's great. If you haven't already, now is great. We've seen rates, they're still at record lows. The 30-year interest rate is sitting at 3.875. We've never seen that before, not in the 20 years I've been doing this. And the 10-year up until a day ago was at 2.875. That's cheap money.
Our first home was 18.5%, I think, in 1983.
Right.
I mean, isn't that amazing?
Yeah. Now we're getting people who are getting a little more creative. Yesterday I had somebody call in inquiring about a future car purchase and maybe buying a lot loan down the road, and they are going to refinance their first and roll those possibilities together, so they have the money at 3%. It's just so cheap.
Well, I mean, I think paying down credit card debt might be a really good reason to consider refinancing, right?
Sometimes, and you have to take into consideration, do you really want to put your credit card debt into your home for 30 years? Is that a good financial decision? And maybe it's a second mortgage where you can make it for only 5 years to give yourself a set goal, because that's part of what got us into the refinance issues we've had today, is that people were rolling things in. Home values continue to rise. So, of course, you roll in your car, you roll in your credit cards, take a little money out, do a little home improvement, and by the time you get done now there's no equity left in these homes the minute the market goes down slightly. So I don't think that in most cases that putting credit cards in the home itself is a good idea.
Okay.
Because it's stretching it out just too far and it's eating up equity. Correct the problem. How did you get all that credit card debt that you're having trouble paying now? Have you sat with a financial advisor to look at options for budgeting and look at a plan? There's on our website there's a place called My Goals, and it's great because you can set up goals and you can actually interact with a financial service rep if you want to, or you don't have to, and you set up a goal to try to get these, whatever it is, whether it's refinancing or buying or paying down debt, but it's all about making yourself commit to making a change.
Similar with a car purchase, you would look at an individual application and determine whether that's a smart use of refinancing?
Correct. If they're in financial trouble and this is gonna help them and it's really gonna save them, that's great, but they have to commit to making changes in the future. Because if you roll in your credit card debt and then a year from now the credit card debt is back, now you're in even worse position because now you've used up the equity in your home. But the new programs out are the ones that are there now to help with the people that don't have the equity left.
Yep. It seems, I mean, traditionally, I think it's always been a little bit of a game, wondering if the rate's going to go down, how often one should refinance. I mean, the costs are something that you need to consider, right? I mean, you can refinance too often.
Absolutely.
Yeah.
Yeah, absolutely. And most people prefer to roll in the closing costs, but when we're running numbers, we still have to figure about when it's realistic for them or smart for them in terms of when they're going to break even on those. Your standard refinances will often run $1,200 to $1,300 if credit's really good, if you're just refinancing your first mortgage and you have good equity. But when people are doing debt consolidations, then it's considered a cash-out refinance, and those fees can go up quite a bit. And that's why you really have to be careful about when you're having people consolidate debt out to 30 years as well.
Yep. Okay, so somebody's watching this show and have been thinking a little bit about buying a home. Now they want to start. What's the best way to start? Go to your website, call you, go to a seminar. What do you recommend?
Both. The website is a great resource tool. All of the loan officers like Brett are out there, so you can click on the one that works best for you, the office that works best for you. And then as far as the seminars are a great way to get started if you're buying.
Yeah, they can actually apply for a pre-approval at summitcreditunion.com. Okay. And it will ask what office is the best for them to work out of. And if basically the loan is then assigned to the loan officer who they want to work with. Or if they know somebody and want to work with somebody, they can put a note in that they want to work with that person as well. And we're giving a follow-up call within a few days, and hopefully meeting with them and setting up a time to review credit and make the process go very smoothly.
Is there a mortgage calculator on that site? Or?
Absolutely, tons of mortgage calculators. Yeah. It's the best place to go because you can actually get approved online. You'll know whether it's a purchase or a refi where you're at.
Well, this has been very interesting. Thank you very much for taking the time. Seminars on the 19th and the 25th, I believe. And you can go to the website to find out what. We'll be back right after this. We didn't get to the home affordability refinance program, and if you don't have equity, that might work for you. I urge you to call Summit Credit Union for information. Thanks for joining us. We'll see you next Sunday on For the Record.